morning. My name is Charene Nortier, and I'm from the Conduct of Business Supervision Division at the FSCA. With me today are my colleagues Bianca de Vries and Marrelie Victor from Insurers and Retirement Benefit Administrators. And they're going to be talking about outsourcing and binder services today. Bianca and Marrelie, thank you very much for joining us.
Good morning. Thank you, Charene. I've opened the agenda today. The presentation today relates mainly to 4 specific areas of supervision, and these are outsourcing arrangements, binder agreements, data, and the transfer of book of business. Now, in my department, we supervise insurers, and the discussion will mainly be from that perspective. It is, however, important that any party that form part of an outsource agreement be aware what the legislative requirements are in terms of these arrangements and what our office consider when we supervise these arrangements. Before I start with the discussion on the topics mentioned, we thought it important to start with a brief introduction on how we supervise insurers from a market conduct perspective. Since the establishment of the 2 regulators under the Twin Peaks model, there have been changes in the legislation and in the manner in which the FSCA supervise. As you would know, the FSR Act and the Insurance Act are the enabling legislation for purposes of prudential supervision. And the FACE Act and the Long-Term and Short-Term Insurance Acts respectively allow for supervision from a market conduct perspective. Now, insurance and supervision of that is no longer reactive. Our aim has been to have a much closer relationship with insurers, to be able to have discussions about their business on a continuous basis, so that we can identify possible concerns before something goes wrong. Insurers are encouraged to engage with our office about the challenges that they experience and that they talk to us about the practical implications that legislation might have on their business and processes. Bianca will touch on the supervisory tools that we use to be more proactive and preemptive and intrusive. Remember that this approach will not only affect insurers, but also all parties whom the insurer might outsource certain functions to. In general, across the industry, we have identified certain concerns, which I briefly want to touch on. Inadequate control functions, and this is very important for oversight, specifically over outsourced functions. The insurer is ultimately responsible for all functions outsourced and should have adequate processes and controls in place to make sure that the outsourced partners comply with what is required in terms of legislation. This then means that the insurer must make sure that their control functions are adequately resourced and that they have the necessary tools to perform this function. So much focus has gone into data. There are still some instances of poor reporting on the conduct of business submissions. We have also noted that, especially in the intermediary models, that the quality of data with regards to claims and complaints reporting, amongst other things, can sometimes be lacking. And one of the reasons here for this is that the outsourced partners do not provide proper reporting to the insurer. We have used thematic reviews to identify concerns. An example of this would be excess structures. We remain concerned about structures that apply multiple excesses and also where a percentage of damage excess is applied. This is specifically a concern when the insured then has an excess of 20% or more of the damages amount, which, as you would agree, would then in many cases result in self-insurance. We will go into more detail with regards to the transfer of books and the concerns related to this. It is important that the correct process be followed and that policyholders are not prejudiced in this process. Then I want to talk about a very important buzzword that you might have heard, and that is a treating customer fairly culture. When we engage with the insurer, all the decisions that they make, the actions that they take combined give us an idea of their TCF culture in that organization. And the same is very true for any other entity that we supervise from the FSCA side. All the areas of focus that I've mentioned paint a picture of what the aim of the entity really is and whether they really want to achieve fair outcomes for customers. I will now hand over to Bianca.
Thank you, Marrelie. If we can move to the next slide, please. So as Marrelie mentioned, our supervisory strategy is to be more proactive and preemptive. And I will take you through or touch on briefly some of the regulatory tools at our disposal to achieve our supervisory strategy and to continue with trends analysis. So in our department, we have different portfolios of insurers assigned to an analyst, and that is for purposes of relationship building. So this analyst will be the relationship manager with a particular insurer and will also focus on trends analysis with regards to this insurer. We also have regulatory reporting that is required from industry through our conduct of business returns, and then there are certain pieces of legislation that places a reporting obligation on the insurer. And some examples of that is when a new binder agreement is entered into, when a binder agreement may be terminated, if the insurer wants to pay a fee higher or a fee higher than the binder caps, because in certain instances, the fee that you can pay for a binder function is capped, but we will get to that a little bit later as part of the presentation. Also, if the insurer wants to pay the intermediary a fee for other than, for a binder function or for intermediary services being rendered, then that also we want to know about it. The FSCA needs to be notified. We also have our on-site and off-site inspections. So we will in a particular year target some of the insurers in the portfolio where we have picked up certain concerns that we would like to have a closer look, and then we will do an on-site inspections. Our off-site inspection would entail the analysis of the conduct of business returns, and also we do that by virtue of relationship meetings. So with each insurer we will book a relationship meeting, and it may be an annual meeting or a biannual meeting or a quarterly, depending on the risk rating this particular insurer is assigned by our department. And I will also touch on this a little bit more in a bit. But also due to size and complexity of an insurer, that will also dictate the frequency of the meetings. We also have engagements with industry associations, the likes of ASISA and SAHIA. We also have engagements with the Ombudsman's Office, and then with other regulators like the Council of Medical Schemes, the Prudential Authority, and the Financial Intelligence Center. We are also empowered with certain, to issue certain documents such as guidance note, directives, and information requests. So these are some of the regulatory tools, although not an exhaustive list, that we have at our disposal. When we engage with an insurer, we have specific focus areas, and the table, as you will see in the table, there's about 9 focus areas that we have. So strategy and business model is very important. The products, we want to know the products this insurer has that they offer in the market, especially in terms of the launch of new products as well. When a new product design, the whole taking us through the product approval process. So we do zoom in on that a bit. We also look at the distribution channels of the insurer. We look at the different types of agreements that they may have with third parties, be it intermediary, outsourced, or binder. We also have engagements with the claims departments, and we'd like to understand more around claims processing. We also engage regarding premium collection, complaints management, and the governance and oversight, and that speaks to your control functions. So we will engage. We have particular questions that we ask. There's certain information that the insurer will submit, and we will then, for each of the areas, assign a rating, and then that will we will derive then at an overall rating based on each of the scores obtained in the different focus areas. If we can go to the next slide, Marrelie. So the risk rating of the insurer, all insurers are risk rated, like I mentioned, and insurers that have many binder or outsourcing agreements in place poses a higher risk to fair outcomes for policyholders. And for that reason, they always attract a higher risk rating from us when we engage. I mean, it's a third party that the insurer has an engagement with, or a contract with, and they rely on them to perform certain functions, and that may pose a risk in terms of fair outcomes for customers. And for that reason, we want to discuss in detail outsourcing and binder agreements.
All right, back to me. I will specifically now speak about outsourcing. And yeah, I want you to remember that binder agreements are a specific form of outsourcing, but we will discuss binders separately. At this point, I just want to note that I realize that our slides are very wordy, but we did think that it would be helpful for purposes of referring back to the slides in future if you have more detail rather than less. So previously, Section 9(3) of the Long-Term Insurance and the Short-Term Insurance Act stated that the insurer will only receive a license if it has the organization and management that is necessary and adequate to carry on insurance business. That is a very loaded, I would say, paragraph. And you know, what would that actually mean? On 12 April 2012, the Financial Services Board, as it was known before, issued Directive 159, and this spoke about outsourcing that insurance businesses did in more specific terms. And it included outsourcing to any other person, but also to insurers or branches of insurers located outside of South Africa or subsidiaries. It wanted to make sure that any form of outsourcing would be included in what we supervise. This directive also determined that the control function, management function, and material functions are the functions that is very important in terms of outsourcing. And it also spoke about the remuneration paid, which should be reasonable and commensurate. And it should be separate from other functions like intermediary services and binder functions. And very important, the directive also said that it should not be linked to claim repudiations. It further noted that there must be an outsourcing policy in place and a written contract. And the insurer at that point was required to report no later than 1 month prior to the effective date of the outsourcing contract to the regulator that it is entering into this arrangement. It must be noted that this was not a pointless notification and that the regulator actually looks at all of these notifications that come in. Current legislation, the Insurance Act commenced on the 1st of July 2018. And together with that, the Joint Communication 1 of 2018 then withdrew Directive 159 from 1 July 2018. It was basically replaced with Section 25(8) of the Insurance Act, which stated that the PA, in the case of insurer, may impose licensing conditions necessary to achieve the objective of the Act, which may include conditions that relate to outsourcing. Section 33A of the Insurance Act speaks specifically about governance. And I think this was a very important inclusion in the Act because it says the Board of Directors of insurers responsible for meeting the requirements imposed on the insurer when it comes to outsourcing and responsibilities relating to that. So it is no longer something that happened in the business by business units. The Board of Directors are expected to understand what part of their business they outsource and what is happening in that area, and they are ultimately responsible. You will further note that Section 34 of the Insurance Act also stated that the PA may prescribe governance principles. And those principles relate to the outsourcing policy, remunerations, functions that may not be outsourced, and limitations and requirements for sub-outsourcing, and lastly, also reporting. So there was, or we have experienced some confusing with regards to certain reporting obligations in terms of outsourcing. And we thought it a good idea to include it here to make sure that everybody is on the same page. The PA is the relevant regulator with regards to reporting on the control management and material functions that is outsourced. However, if I say material functions, those are all material functions other than binder functions. The forms that the PA have for reporting, currently there are 3 forms, and they want to be notified if any material business is being outsourced, if that agreement is being terminated, and also if there's a material development with regards to outsourcing. And I've also referenced a few other documents there brought out by the PA that speak specifically to these requirements. Even though the PA receives and processes these notifications, it is valuable for the FSCA to be aware of the changes in outsourcing. So the Prudential Authority usually shares this information with our office, and we find that that really enables us as the regulators to work together and to understand what is happening with insurers at any given time. I'm now going to move over to binder agreements. So I'm sure that all of you know the legislation with regards to binder agreements quite well, more specifically Section 49A of the Long-Term Insurance Act and 48A of the Short-Term Insurance Act. There are 5 very specific functions that must be outsourced in terms of a binder agreement. I'm not going to go into detail here. I think what is important is that you know the contents of what is included in Part 3C and Part 6 of the long-term regulations and Part 5B and Part 6 of the short-term regulations. These regulations specifically deals with general principles for determining remuneration under binder agreements, the remuneration that may be offered to a binder agreement, limitations and requirements and prohibitions relating to binder holders and then the binder agreements, governance and oversight requirements, that's quite important, and exemptions and reporting requirements. I just want to, before I move on to the next slide, want to mention the governance requirements specifically. The responsibility on the insurer is very high, and for that reason, the requirements that they set for binder holders might be quite strenuous. We often hear from insurers that intermediaries say that they are being too strict or the burden of what they ask is too much. And I think what we want to emphasize today is we require that from the insurer, and that is why they have to ask certain things from intermediaries. With regards to just a few things on governance and oversight, it is the responsibility of the insurer before entering into a binder agreement to make sure that this binder holder has the necessary resources and ability. The insurer must have the necessary resources and ability to exercise oversight, and that the insurer must on an ongoing basis exercise oversight. It must satisfy itself that the binder holder also has governance, risk management and internal control frameworks, that the binder holder has the specific technical expertise to perform the functions. It must have controls in place to make sure that it can trust the information that the binder holder provides. The insurer must be able to react and address to any shortcomings that might happen in the duration of this agreement. And then data. We do require that the insurance must, before entering into a binder agreement and all times after that, have the operational ability to ensure data integration into the technology systems between the insurer and the binder holder. But Vanessa will deal with that in more detail later. As I said, there's also reporting on binder arrangement to the FSCA. And I want to mention these specifically and the forms that we require. I think everybody is pretty familiar with the fact that we require notification in terms of a new binder agreement and a binder termination. The forms ask quite a bit of information, and for that reason, the insurer might probably ask a lot of information from the intermediary in order to be able to answer that. And when we scrutinize these notifications, we might engage in conversation with the insurer that submitted the notification. with the intermediary involved, and in the case of a binder termination, even with the new insurer, if there is a new insurer taking over a book of business. So a lot of work goes into looking at what we are being told, and every single notification we do process in our office. And it gives us a very good idea of how the insurer is running the business, how frequently new business comes in, how frequently agreements are terminated. So it actually helps us a lot as a supervisory tool to understand what is going on in the business of the insurer. The other form that we want is that we want them to report if they want to pay a binder fee in excess of the binder caps. This is something that we have to consider in great detail because a lot of work has gone into determining the binder caps. So the insurer must really be able to motivate what it is that this intermediary is doing that would validate a payment higher than the binder caps. I know of instances where this has been allowed, but it is not something that we just grant on a daily basis. The last two notifications that I want to mention is if there is an associate relationship between any of the parties. This affects possible conflicts of interest that may arise, and this often happens when we have binder agreements in place. So insurers must report this to us, and we usually look at the controls that they then have in place to mitigate the conflict of interest. If the proper controls are not in place, we will, for example, expect of the insurer to regularize this arrangement and even do away with the associate relationship if possible. And then also a very important one that has been the topic of quite a bit of conversation is the insurer must notify us if they want to pay an entity basically what we call an outsourced fee, as it is a fee other than services for services of an intermediary or a binder function. I think the reality is that the definition of services of an intermediary is quite wide, and a lot of things that insurers want to pay additionally for might fall under services of an intermediary. So in this instance, we have extensive discussions with insurers to understand why they feel that this specific function for which they want to pay outsourced fees will not form part of intermediary or binder functions. This column you will also be very familiar with. These are the binder caps that you can pay for the different binder functions. I just want to mention that this only applies to non-mandated intermediaries that provide advice as defined in the Phase Act. Very important, an insurer is required to explain what they see as binder function fees, intermediary services fees, and then outsource fees, as I explained earlier. And we have seen and identified some creative ways in which insurers try to validate certain fees and say why they do not form part of binder function or intermediary services in order to pay intermediaries more. We do scrutinize this in detail, and we do ask the insurer to provide us with a lot of documentation around this. So know that this is really a topic of discussion, as we do need the insurers to not remunerate twice for the same function. I will now hand over to Bianca to talk to you about data and transfers. Thanks, Bianca.
Thanks, Marrelie. So in terms of the extent of which I will be discussing data today, it's in the context of the binder agreements as explained by Marrelie. So we have regulations and some of the policyholder protection rules that took effect on the 1st of January 2020. Insurers had to comply with that who have binder arrangements in place. So the first one, Regulation 62A, speaks about governance and oversight requirements of the insurer over the binder holder. So it states in brief that an insurer must, before entering into a binder agreement and at all times thereafter, be satisfied that the binder holder has the operational ability to ensure integration between the information technology system of the insurer and the information technology system of the binder holder. So Marrelie touched on that briefly as well. And in a short while, we will go into exactly what the definition. If we say integration, what does that mean? Because that term is specifically defined in the regulations. But important, before entering into the binder agreement and at all times thereafter, that the insurer must ensure that there is integration between the IT system of the insurer and that of the binder holder. And then the next one, Regulation 6.3, the requirements, limitations, and prohibitions relating to binder agreements. The insurer has the right to, and I need to place some emphasis here, it is a right the insurer has to access any data held by the binder holder as and when such data is requested by the insurer, and require the binder holder to provide the insurer with access to up-to-date, accurate and complete data in accordance with Regulation 6.2a2 on a daily basis. So you will note the feedback that we've gotten from industry as well, since these provisions were enacted and they had to comply, is that it is quite onerous if an insurer has, for an insurer to comply with these regulations or these provisions. However, the insurer is relying on the binder holder to perform certain functions, and it is very important that the insurer also has access to the data and, on a daily basis, know if there's any updates, if it changes, because the insurer at any point in time, if something happens or goes wrong with the binder holder, the insurer should be able to step into the shoes of the binder holder and perform those functions. And then the insurer must have the relevant data to be able to service the policyholder effectively. So that is why these provisions are so important for the relationship of an insurer and a binder holder. Next slide, Marrelie. Then we get to the definition of integration. So integration means policy and policyholder data is in a format that is readily recognizable and capable of being meaningfully utilized immediately by the core insurance systems and applications of the insurer. So some of the feedback that we've gotten and from the risks identified in industry previously was that there was some data being shared, but the data was not necessarily in a format that could be used or absorbed by the systems of the insurer. So a data dump would typically come through, maybe in an Excel spreadsheet, and the insurer is not able to meaningfully utilize that data, to service the policyholders. So integration says it's very important that the data is recognizable by the system of the core system of the insurer, and also it must be able to be meaningfully utilized. Then we also have Rule 13 of the Policyholder Protection Rules, which states that an insurer must have an effective data management framework. So this also places obligations from a data perspective on the insurer, and that, of course, with the outcome to provide more protection to policyholders. What is of particular importance with this provision is where an insurer outsources the processing of any data, the insurer must be able to access such data at any time as and when required by the insurer. So it is that for 24-hour, obligation in terms of a binder agreement that is placed to say on a daily basis, the insurer must have access to that data. And again, the insurer has the right, so it's a right of the insurer to say, but I want this data and this data needs to be provided to me. And then in terms of Rule 13, of the PPRs, just a bit more obligations around this data management framework. Okay, we can move on, Marrelie, thank you. So transfers, I will touch on transfers briefly. So when we talk about transfers, it's a transfer of book, either because the insurer decided to cancel a product, it was underwriting, or where an intermediary decides to move a book of business to a new insurer, so from one insurer to another, but the current insurer is still prepared to underwrite the policies. So those are the two main kind of scenarios that you need to distinguish when it comes to transfers. We also have a third one, which is a transfer in terms of the Insurance Act. For that one, it particularly speaks to transfer of assets and liabilities from one insurer to the next, and then the policyholders will also move to the insurer where the assets and liabilities are being transferred to. But for purposes of this discussion, so the first one, where the insurer decides to cancel the product, the intermediary has to engage insurers in the market, because now the intermediary needs to find an alternative underwriter for this product. In all likelihood, the intermediary will be subject to a due diligence by this new insurer or new underwriter that it seeks to do business with. This might be a lengthy process to complete, so enough time has to be factored in order not to leave the policyholders destitute and without cover. We have seen this so many times in industry where there's been, the intermediary finds a new underwriter, and then the process of the due diligence may take anything between 1 month to 3 months, because the insurer also, or the underwriter, needs to be sure in terms of this business that it's taking on and the risk that it will be underwriting. And then with the previous insurer, that relationship may terminate, and then there might be a month or two where insurers, policyholders are left without cover, and that obviously, should a claim arise in that instance, that will be a big risk and lead to bad outcomes for policyholders. Policyholders need to be communicated with and notified of this change, and then all periods of notice needs to be complied with. So normally it's 90 days between the insurer and the binder holder, and then 60 days. So 60 days before termination of the agreement, the authority, the FSCA, also needs to be notified, and then there's a 30-day period within which the policyholder needs to be notified. And then the second scenario, where the intermediary decides to move books, but the current insurer says, listen, I'm still prepared to underwrite these policies. In this instance, consent must be obtained from each and every policyholder. So the intermediary needs to engage the policyholder and tell them, this is what we intend to do, this is what it means for your cover or for your policy, and these are the options currently on the table. And should the policyholder decide to move to the new insurer, they must explicitly consent to do so. But as our note below states, regardless of the scenario, communication with policyholders is obviously key in every scenario. So transfers in general, there are some concerns with the movement of books that we've identified, and those are the reasons for the movement. Why is the book moving? Is it to obtain more fees? The insurers are not underwriting the policies properly. There's a reckless handing out of binders and broker agreements without proper take-on and due diligence and ongoing oversight. Because what we've also seen is that initially, when at onboarding of a new binder holder, a due diligence is done, and the insurer makes sure that everything is in place. But as the relationship continues, a year or two into the relationship, we see that, that ongoing oversight may be lacking a bit, and it is not that monitoring of the requirements that were met at take-on is not properly overseen by the insurer as it should. No ineffective root cause analysis of complaints. So complaints is not properly looked at, and the root cause analysis being done is also absent. Clients are prejudiced with double debits or unfavorable policy terms when policies are transferred. So ideally, if a policy is being transferred, the cover should be like for like. It should be with the new insurer as it was with the previous insurer. And then we also find, in terms of the premium collection, at some point there may be 2 premiums going off, one for the older insurer and one for the new insurer, which is obviously not ideal. The arrangements with entities that do not have the necessary skill or resources. So like we said, I think that touches, or it links to the previous point of reckless handing out of binders. This may be a quick arrangement, and the people that they are now entering into does not have the necessary skill. And then double payments is also another concern that we've identified that comes about with the transfer of books in general. We can go to the next slide, Marrelie. The legislation regarding transfers is termination of policies by the insurer. So this speaks to policyholder protection rules. The policyholder protection rules issued in terms of the Short-Term and Long-Term Insurance Act, and the specific rules we want to highlight is Rule 19 and Rule 20 respectively. So in the event that an insurer terminates a policy, so this is termination by the insurer, in circumstances set out in Rule 20, the insurer will remain liable under the policy for the shorter of a period of 31 days after the date on which the insurer receives proof that the policyholder has been made aware of the intended termination of the policy. So here you will see the period of 31 days is very important to note, and or the period until the insurer receives proof that the policy entered into another policy in respect of similar risks to those covered under the policy that the insurer intends to terminate. So two things here. Firstly, the insurer must either in a period of 31 days receive proof that the policyholder has been made aware of the termination. So a notification has gone out and then 31 days elapse and then the insurer may terminate, or the period until the insurer receives proof that the policyholder has entered into a policy of a similar nature with a different insurer. So those are the two things when an insurer wants to terminate. Also important to highlight here, the right to terminate or cancel will be guided by the terms and conditions of a particular policy. So the right to terminate emanates from there. However, the policyholder protection rules obviously just wants to give that extra protection to a policyholder that they have adequately been notified of this termination. In the event that the insurer is unable to obtain the proof referred to in the rule above, the insurer must be able to prove that a period of 31 days had passed since notification was sent to the last known address of the policyholder, and it took all reasonable steps to ensure the contact information of the policyholder is correct and to contact the policyholder. Again, just referring back to the data, you will see in each and every topic that we've touched on thus far, data is so important and integral to when it comes to binders, even to transfers. Again, here, the only way that the insurer will satisfy itself that the notification has reached the policyholder is if they have up-to-date information regarding this policyholder, contact information, so they can make sure that the communication reaches the policyholder and the policyholder is notified effectively. The binder cancellation, so Marrelie touched on the binder cancellation notification, which comes to the FSCA. So some of the questions we ask upon receiving. So once the FSCA are in receipt of these notifications, we do analyze them, and these are some of the questions we ask. The number and type of policy, so we want to know how many policies does this book of business comprise of, and also the type of policies, the gross written premium that was earned on this book, the loss ratio, what is the loss ratio looking like on this book, and might that be one of the reasons for this termination, whether it's a unilateral termination or not, who the new insurer is, where is this book of business going, compliance with the notice periods. I mentioned before that there is the 3 time frames that we look at, which is the 90-day period, the 60-day period, and the 30-day period for policyholders. So we do check in our analysis for compliance with those periods as well. Communication to policyholders, whether the necessary consent in the event that the circumstances require has been obtained, and also have they been notified of this termination, and what does that communication entail that was sent to policyholders. Details of any outstanding premiums and claims, especially in the time of transition. How will the claims be handled, and how will the service to policyholders, what will that be looking like? And then, of course, the access to data, which is also very important. So these are some of the questions that we would then go back to and engage the insurer with upon receiving the notification. Okay, this brings us to the end of our session today. So some concluding remarks that we would like to leave with you. This one is not on the slide, but I want to urge you we have mentioned a lot of different pieces of legislation, from the Insurance Act that speaks to, the outsourcing supervised by the Prudential Authority. Marrelie touched on numerous regulations, the sections that spoke to the binder agreements, the different caps. And then in terms of the data, I also mentioned, some provisions from the regulations and then the policyholder protection rules. So I would like to urge you to go back in your own time and just pay attention and, take note of those provisions and read over them again. I think it is important for your engagement as intermediaries with the insurers to understand if there's a particular request that comes from the insurer, what is the legislation that places that obligation on the insurer to request the specific information from you. So some of the questions that we ask at on-site inspections, we do zoom in on what are the biggest risks that the insurer has identified with regards to outsourced relationships. We also look at the onboarding process for intermediaries, outsourced partners, and binder holders. So how do they onboard? What is their due diligence looking like, etc.? Have they made sure, the integration between the systems for data purposes is taken care of? We ask for the proof and quality of ongoing due diligence on outsourced partners. So as much as it's important to do it upfront when there's onboarding, that ongoing, for them to monitor actually these partners from a risk perspective is also very important. What fees are paid to intermediaries, outsourced partners, and the binder holders. So like Marrelie mentioned, we would not like there to be a duplication of remuneration in respect of the same function being performed. So that is quite important to us as well. Are binder holders required to use specific IT systems? How often is the data being received? And is the insurer able to service the policy based on the data received? And I think that goes back to the integration definition. It must be meaningful. It must be, on a daily basis, and it must be up to date. Also, the details on complaints related to outsourced partners. We've had some instances where, an outsourced partner was responsible for an increased complaints ratio, for example, at the Office of the Ombudsman. So we will then zoom in on those kind of instances and ask the insurer, are they aware or what are they doing about the situation? And then also details of the collection of premium process, should this be outsourced? So if insurer is asking an intermediary to collect premium on their behalf, then also, what are the details around that premium collection? We want to ascertain then from the insurer. So I think, that brings us to the end of the session today. Marrelie, I don't know if you would like to also say a final word in conclusion before we hand over to Charene.
Bianca, I think we've covered it all. I think we've mentioned certain topics more than once, but that is just to emphasize the importance of specific points that we made today. Thank you.
Bianca and Marrelie, thank you very much. That was incredibly informative and very useful. I know that for a fact I'm going to be taking a look at this webinar again, because you mentioned a lot of details that are incredibly important to understand from an intermediary perspective. And obviously what you said, and especially the tips about what you look at during on-site inspections, will be useful to the insurers who are also watching today's webinar. For those of you who watched today's webinar, I hope that you found it really informative and useful. And we also want to just remind you that we have accredited all of our webinars with the Financial Planning Institute. So each webinar is recognized for CPD purposes. And for you to qualify for CPD, you have to answer a couple of questions that are based on today's webinar. So if you find yourself facing a question that you're not sure about, please listen to the webinar again, because you will find the answers for the questions in the webinar. Thank you so much, and I look forward to our next webinar. Have a wonderful day.